Hi, my name is Andrei Jikh. Hope you're feeling well. Hope you're doing better than I sound. I sound a little under the weather, but that's only because I am. Now, in today's video, I wanted to go over some of the safest places you could park your money right now. I compared investing $10,000 into some of the safest stocks, the best bonds, and the highest yielding savings accounts just to see where you could park your money that isn't taking on a ton of risk, but hopefully ends up making you some money, which was a challenge because in today's market, virtually everything you invest your money into is losing value, whether that's stocks, crypto, or probably real estate very soon. So before we talk about some of those best places, let's first address what is going on in the markets today, because the Dow Jones is down 900 points. It is down 4 weeks in a row, and just last week, we had the worst day in the stock market since 2020. Also, the Fear and Greed Index, which measures people's sentiments and feelings toward the stock market, is now at 40, which means we are officially in fear mode. And when it comes to crypto's Fear and Greed Index, we're at 24, which is extreme fear. So people are becoming very scared, and keep in mind, all of this is happening while we're still in April, and this doesn't even take into consideration May, which is sell in May and go away, where people sell their investments and go on vacation, and that's usually when May is not a good month for investors. And all of this pent-up fear could spell a bad month for us come May, and that's why everyone is shouting that this is the end of the bull run. Except for Jim Cramer, which is how you know that this is the end of the bull run. I'm just kidding. Now let's talk about some of the safest stocks you can invest in right now. So this first list was recommended last year by CNBC, and it's called the Magnificent Seven. And anytime the mainstream media talks about specific stocks, I always like to track them just to see how well they've done. So if you invested $10,000 with them, here's how well you would have done. But please keep in mind these numbers are year to date, meaning starting from 2022 up until now. And also please keep in mind that stocks are supposed to average 7% per year. So if they lose more or multiples of 7, I think about how many years worth of progress was lost, but that's just how I do it. This Magnificent 7 is made up of companies like Netflix, Tesla, Roku, Peloton, PayPal, Square, and Zoom. So far, Netflix is down 63%. Roku is down 58%. Tesla is down 16%. Peloton is down 42%. Square down 37%. PayPal down 55%. And Zoom down 45%. So this is bad. If you had invested $10,000 equally into this list of Magnificent 7, you would be down 45%, and your $10,000 today would be worth $5,500, or roughly half of where you started. Now, to be fair to this list, some of the companies on this list are a great buy and hold for the long term, but sometimes it doesn't work out in your favor, especially in the tech sector, which can move very fast. What I find the most fascinating, though, is that if you took that $10,000 and instead bought Bitcoin with it, you'd still be down, but you'd be down 17%, not 45%. And that's kind of crazy to think about, that we live in a world where massive tech stocks are more volatile than risky assets like Bitcoin. Kind of interesting. So instead, here's my list of some stocks that I've been buying that have done well for me. This is not financial advice, I'm just sharing with you what I'm doing. And the first stock that I love is the S&P 500, as it's represented by one stock, which is VOO. This represents the top 500 companies in the US. I've been dollar cost averaging into it, and so far I'm down 3.36%, but that's nowhere near as bad as 45%. A stock that I like even more than VOO is VTI, and this represents the entire US stock market. This one represents several thousand stocks inside of just one ETF, and this is the one I've been buying a lot longer. This is the one I'm dollar cost averaging into every single day, and I'm down a little over 5% on this one because I've been in it for a little bit longer, but again, it's relatively comparable to VOO. They are virtually the same stock. Now, on the dividend side, or the fixed income side, I've been reinvesting all of my dividends into VYM. This is the Vanguard High Dividend Yield ETF. So far, I am up over 39% on this one, which is pretty insane. And on top of making dollars on top of my dollars, I'm also being paid passive income, and I'm earning roughly 2.6% yearly income, which translates to $80 per quarter, which is pretty amazing, and it's enough to pay some of the bills in some cases. Now, my other favorite dividend ETF that I reinvest my dividends into is SPHD. I have a $10,000 position inflation here, and I'm up over 56% on it, which makes me look like a genius. But the reality is, I've been in it for such a long time that it's just done so well for me. But this is one of my favorites because on top of making money on top of money, I'm also being paid roughly $30 a month for owning this stock. And that's really cool. So a lot of these stocks have not made me a ton of money, but they also don't lose a ton of money, which is really important in markets such as these because it allows me to invest in the markets for the long term and sleep well at night knowing that I'll be okay and that mathematically investing in broad market index funds is really the best strategy, and it's proven to be so time and time again. Now, before we get into the best bonds you can buy into, let's first talk about why the stock market is being so beat up right now. The first reason that the stock market is falling is one very simple reason, and that of course is earnings. Now, this is not going to make sense, but check this out. The total earnings per share for the S&P 500 in the first quarter of this year was 8.7% higher than what analysts expected. So even though we are beating expectations, stock prices are still going down. And how can that be? And the first reason for that is because right now stocks are overvalued. They're expensive to begin with. And that's because historically speaking, for example, the price to earnings ratio for the S&P 500 has traded anywhere between 13 to 15. And right now, the S&P 500's PE ratio is closer to 21.5. So clearly, we are overvalued. And that means we are that much more extra sensitive to bad news, and we have to overcome expectations that much more for the prices to go up and for investors to get excited again. The second reason the stock market is in free fall is because we're finally seeing Papa Powell in peak hawk mode. It's his ultimate final form, and like the dove mode that he was in before where he was accommodative and he was printing money. He said on April 21st, on Thursday, that he did not think that inflation would hit its peak in March, which means for April's numbers, it could get even worse. And remember, April's numbers don't come out until May because we're always a month behind in data. And the stock market anticipates this and it becomes scared because it knows that the Federal Reserve has to fight inflation harder than perhaps we thought before. In fact, the CME Fed Watch website is estimating an 87% chance that the Federal Reserve will increase the federal fund rate from 0.5% that it's at right now to anywhere between 2 to 2.25% before the end of the year. And that's a huge difference. And that's how, as soon as people heard the news of this, the market priced it in, and that's how it sold off. But also, if we take everything we've learned about interest rates going up and how it negatively affects everyone, we also have to combine it with the fact that the Federal Reserve will soon start to sell off their bond portfolio. This was the opposite of money printer go brrr. This is money printer go brrr. I don't know. It's sucking up all of the money that we've printed. And when that happens, the interest rates on bonds or guaranteed investments goes up, and it makes them more attractive than stocks. And that's how, when stocks suffer, bonds typically do better. And it just so happens that I found one of the best bonds you can invest $10,000 into right now. I've mentioned them before. They are the I-bonds. Not affiliated to Apple, Steve Jobs did not create them. It was actually designed by the government to give the average American a chance to save their money in times of high inflation like we have right now. And I want to tell you about what they are, where you can buy them, and how they work. I wish more people knew about this stuff. I nerd out about it, but huge shout out to the Coronator on Reddit for providing some of the info. Now, the way that I-bonds work is they have two interest rates, one fixed rate and one variable rate. Right now, the I-bond fixed rate is at 0%, which is a bummer, but it makes up for it because their variable rate right now is locked in at 7.12%, which is huge, and it's gonna last until the end of this month. Now, come May, that variable rate is going to readjust to a whopping 9.6%, which is just huge. That's more than you would expect from the stock market and more than what you would get from some of my favorite dividend stocks, and now is a really good time to learn more about them. By the way, the reason you might not have heard about these I-bonds before is because their interest is directly tied to the CPI, which is the thing we use to measure inflation, which right now is really high, and that's why it's getting more attention. And the other reason is because they're directly from the government. There's no expenses, no commissions, and no fees, which means there's no one really out there to promote them to you because there's no incentive to, and that's why they fly under the radar, but they are amazing. Interest on I-bonds is generated monthly, and it's compounded semi-annually or every 6 months until they reach full maturity, which is 30 years, or when you cash them, whichever comes first. And this is awesome because it means you don't have to pay unnecessary taxes like you would with dividend stocks. Because with dividend stocks, every time you get paid, you have to take that into account as income and you have to pay taxes. But with these I-bonds, you only pay taxes once when you go to sell. And when you do pay taxes, you only have to pay federal taxes, not state and local income taxes, which is really, really cool. In fact, they are so cool, they can be 100% tax-free if the money is used for educational purposes, like maybe paying for a college tuition. But the best part about these I-bonds is that they don't lose value. In other words, if you put in $1,000, you will get back no less than $1,000. And this is true even if we hit an environment where there's deflation and interest rates go negative. You will get back exactly what you put in and not a penny less. And that sounds way too good to be true. This sounds like they are the perfect investment anyone can make, and in a way, right now, they kind of are. But they are also a government subsidy. And like all subsidies, there's a limit. And here's what the limits are. One of the limits of buying I-bonds is that you have to hold on to them for at least 1 year or 12 months before you can cash them out. And once you do, if you sell them between year 1 and year 5 of ownership, you will lose the last 3 months of interest payments. Now, that is not a huge price to pay, but that is something you should be aware of. Another downside of I-bonds is that you can only buy up to $10,000 worth per year per social security number. So you have to have a social security number, which is the other downside. Hopefully you have one, but that's the limit. Also, you can buy an additional $5,000 worth of paper I-bonds if you choose to get your tax refund in I-bonds. The only downside to that is if you're married and you're filing jointly, you will have only one tax return, and that extra $5,000 is per tax return. So if you're married and you file separately, you can each get up to $5,000, and that's another thing to be aware of. But there are a few tricks you can do to get around some of the limits. You can put an additional $10,000 worth of I-bonds directly inside of your living trust. So if you have a living trust set up, you can actually put your $10,000 worth of I-bonds inside of them, and theoretically, you could set up as many living trusts as you'd like and invest those $10,000 worth of I-bonds. The only downside is it becomes a headache to manage, so please consult with your tax professional to make sure that this is allowed. I'm not a tax attorney, so I wouldn't have all the answers for that, but one of the reasons why this strategy is so powerful is because it supercharges your emergency fund. In other words, if you know you have $10,000 as an emergency fund laying around, you know that this is money you're not going to directly need right away within at least a year, but you also don't want to risk it in the stock market. You don't want to risk it in crypto. You don't want to buy Bitcoin with it, but you also don't want to leave it hanging in a savings account where it's losing money to inflation. This is the perfect option for that. And you don't have to spend your entire emergency fund to get to $10,000 either. If you want to stay liquid, you can ladder in, which is a strategy where you put, let's say, $1,000 a month until you hit your target. And it's just a great way to get into that. By the way, I'm not sponsored or paid by the government to promote or talk about these to you. I just thought they were really cool. So if I've convinced someone out there, I will leave a link in the description below the video where you can go and sign up. But just heads up, this website looks very sketchy. It looks like it was designed in the early 2000s era, but I guess that's how you can tell it's a legit website from the government. Also, if I've convinced you, then don't wait until the end of this month to sign up, because sometimes it takes a couple of days for the transaction to clear, and you want to make sure to lock in April's rates so you're ready for the crazy rate increases for May. The third investment I looked into is a zero-risk, high-yield savings account that's free and doesn't charge any fees. And unfortunately, all of the accounts I've looked at don't even come close to touching inflation, which means unless you're investing and taking a risk somewhere, you're gonna lose purchasing power unless you go the route of I-bonds. That's what I'm gonna do with my money, but if you're someone who wants to stay liquid and you need the cash, then the best ones I was able to find is Ally Bank and Marcus by Goldman Sachs. I'm not sponsored by them, but look into them. They're paying anywhere between 0.5 and 0.6% per year, so you're not gonna make that much money, unfortunately. Either way, Anyway, I hope this was useful, and as always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Grab your free stocks, links down below. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes Wednesday. Bye-bye.